So I just wanted to just talk about the markets and the economy. For those who don't know me, I've been in IT for 30 years. I've been investing in stocks. I also own real estate. I do a lot of work with ETF trading, options, and I love studying macroeconomics. So this is kind of where this conversation's coming from. Definitely want you guys to stop me and argue or ask questions along the way. I have about 10 or 15 slides, but we can take as much time as you all want to if you find any particular point interesting. I'm also a Bitcoin guy, and so I have a bonus slide at the end. So the main thing is, where are we at with this recovery since the shutdowns? You hear a lot of economists talking about a V-shaped recovery, or a double dip or W-shaped recovery, or a K-shaped recovery. The main issue with every recession is the deflation spiral, right? So layoffs cause demand to fall, consumers spend less money, that causes companies to lose value or lose revenue, and then they start defaulting on their debt, especially if they're over leveraged. Then we have bankruptcies, which causes more layoffs, and the cycle continues and continues. This was in full gear back in March. And then about a month later, the Fed and the government got involved and tried to put a big stop to the spiral and tried to turn it the other direction. So we're going to drill down a little bit into what's going on. So the Fed, bolstered the economy by basically overwhelming the system with reserves. And then very shortly after, the government went and spent trillions in deficits in order to stimulate and basically to replace the missing income from all of those folks who were laid off at the low end of the spectrum. Now, if our deflation spiral continues, right, we could end up with a kind of a double dip recession or a long-term recession, depression type scenario. But what we're seeing today is more like a K shape, where some sectors have recovered quickly and are actually doing just as well as before or even better, and other sectors have failed to recover. So these charts are probably hard to read on the screen, but these are from Yelp, just showing how local small businesses have been hit. We see here on the left side here that restaurants and shopping, we have 60% permanent closures of all the closures that have come in. You can see this trend here from April through August of the permanent closures of businesses continues to grow. And of course, as you probably all are seeing around you, these are the sectors that are having the most difficulty and are not coming back. That caused a giant unemployment situation. So we had unemployment rate, this is the unemployment rate for the US, jumped way up to 14, 15%, and it has been trending down. We're down to about 8.5% now in the US. Minnesota, 7.1%, very similar chart. And you can see that it's been trending down, which is great, but it's still way higher than we were since 2011 or so. So we're at the levels now similar to the Great Recession. We should see a jump in unemployment rate when the airlines continue their layoff programs. They had a moratorium. They promised the government they wouldn't lay off people to get free money, and that expires October 1st. Initial jobless claims is probably the most important thing I'm looking at right now. And every week we get a number from the government, from the statisticians. We are at an average weekly rate of about 834,000 for the last 5 or 6 weeks here, where we have 834,000 new unemployed every week. This is as high as the peaks from 2008 and 9. And again, the airline losses are still coming. This does not include the 630,000 pandemic unemployment assistance, which is the extra program that came with the CARES Act. So 26 million in the country are getting assistance. For the this really cool chart from the tracktherecovery.org shows that high wage employment, like most of us who are employed, IT workers and folks who could work remotely, work from home, we're back to where we were at the beginning of this year, and we're only down 1.6%. But the low wage employment group is down 16% since February 1st. So this really shows that the two parts of the K, the one part of the economy is just doing fine. The lower end of the economy is still dogging it. So how does consumer spending come into play? Well, usually when people get laid off, they spend less. But what happened is everyone who got laid off got $1,200 free money, and they got extra $600 a week of unemployment payments from the feds. And so they just spent it all pretty much. That's what happens when you give stimulus to the folks at the lower end of the spectrum. And so you can see here on the left is the consumer spending is only 3.8% down since the beginning of the year. And consumer confidence is another chart here, is showing consumer confidence is low, and it seems to be turning down a little bit the last couple of weeks here. So that's a risk area. So again, back to our deflation. So we have layoffs are high. The demand has not really fell down yet because the consumers kept spending. Now let's talk about debt defaults. So at the beginning of the pandemic, we had this huge spike in the corporate bond spreads, which are causing companies to have to pay a lot more for their funding, and that came down as soon as the government got involved. The Fed got involved in buying corporate bonds, and bond market investors jumped into that trade. So corporate bonds have been coming back to a more reasonable level, but now there's a little bit of an uptake, and definitely something to watch in the next month or so is will the corporate bond spreads explode, which could really cause a problem for the companies that need to refinance or to extend their debts. And then bankruptcies. This is a chart from the FT, which kind of shows 2020 in red here, 2009 in dark blue. And we're already at the levels pretty much of 2009 for number of bankruptcies in $1 billion companies and larger. So the trend is not good here. It's probably going to exceed 2009 as the number of bankruptcies come out. So the biggest question really, if you look at the economy, is are we going into a deflationary spiral, or have we flipped it, and are we going to go into an inflationary trend? On the inflation side, we have globalization that's reversing. We're probably going to bring more things onshore. We have trade war and tariffs that add costs to the supply chain, right? We have supply chain issues with manufacturing being done in multiple countries and difficulty of getting the supplies where they need to be, parts shortages, production disruptions, even food production disruptions, and mining, lumber. Pretty much every industry has had issues where the shutdowns during the pandemic have caused disruptions. We also have free money being helicoptered out to all the people in the country. That free money is inflationary because people tend to spend it, and the deficit spending in general is inflationary. We also are talking about universal basic income, increased minimum wages, giving money out for medical, rent assistance, all of those things are in the same theme. Purchasing power of the dollar versus the other currencies. So is the U.S. Deficit spending more than it is in Europe, more than it is in emerging markets, then the U.S. dollar will drop in value. So causing the purchasing power to be much more difficult and increasing our costs of the supply chain. And then just in general, loose credit conditions would cause inflation. So if the banks were lending all the trillions of reserves they got, we would worry about inflation picking up big time. And inflation tends to bring higher interest rates. Then on the deflation side of the page, you know, pandemic lockdowns, restrictions, those are very deflationary. It stops production, it stops work, it stops the economy. Loan defaults, insolvencies, bankruptcies, business closures, all those things are deflationary. We end up with more capacity in the economy and less demand, or not enough demand to fill that capacity. Of course, unemployment and then tight credit conditions. The banks are not lending. That causes the deflation to continue. And then, of course, lower interest rates are an indicator of we're in a deflationary world. So if you balance between these two, I think we are still in a deflationary risk. We definitely see inflation coming, and you know, your grocery bill is probably a good way to see some of it. But I think we are going to see deflation for a while longer before we see inflation. But this is the biggest topic macroeconomic talkers are talking about right now. And so our Federal Reserve turned on the money printers. They made trillions of dollars by basically buying, or quantitative easing, buying assets off of the banks. So they bought treasuries. They're buying just as much this year as the entire federal deficit. So basically, you could say the Fed is funding the federal deficit. What they do is they buy the bonds and the mortgage-backed securities and even corporate bonds. They're buying those from banks or holders that hold them with banks. And as they do that, they put the money in reserve at the bank. But that reserve money is a collateral account at the Federal Reserve. It's not money that the banks can actually give out as loans, but they can write loans against them. So who creates the money is the banks, mostly the national banks, the large banks. And so the whole process is kind of broken. We gave trillions of dollars to the banks. They loaned a bunch out for the Paycheck Protection Program. But as of the beginning of April, they stopped the rate of which they expanded that the bank or the loan supply has come down. So this white line is the money supply on the Fed balance sheet. And the red line is the amount of loans given to commercial and industrial businesses from banks. You can see here there's a divergence, and this is really a big risk. If the banks don't lend that money out, the entire economy slows down because the economy grows and the GDP grows with loan growth. Also, this chart, which is impossible to read probably, shows the percentage of banks reporting increased willingness to make consumer installment loans. So you can see here, we have had a nosedive since the beginning of this recession, and it has not come back up yet. So they're not, extending loans for installment loans, home equity loans. We're not getting a lot of that from the banks. Anecdotally, Glenn was talking to some bankers, and you said that they were pretty tight on giving any loans to businesses, especially businesses that would be deemed more like startups or small business. So we're getting some anecdotal evidence here that large and small banks are not lending the money, and this is the biggest problem for the economy. I'm going to pause there. Anyone interested in asking a question or anything around lending and how the money gets created?
So how does it compare with Europe in terms of money creation?
Actually, I don't know. I don't have authority. I don't have a lot of data on that I've looked at recently, but Europe is just as aggressive as the U.S. is with respect to quantitative easing and methods or processes like that in order to lower interest rates and push rates down. So they've been just as aggressive as the Fed. What's the difference, though, is a kind of an order of magnitude larger in the U.S. is the fiscal stimulus. So literally the giving of money to people is probably 10 times bigger in the U.S. And that's the piece that's different. You know, in Europe, they can't get their acts together, right? All these European countries have to agree to deficit spend and in how to do it so that, you know, Italy doesn't go crazy while Germany is trying to be tight. And since they haven't agreed to anything, they haven't done anything. I think they just made one deal back in July or August. That was the first time that we were able to get together and actually make some kind of agreement for stimulus.
What about Canada? Like, is the U.S. at the top of the stimulus mountain?
For sure. Yeah, by far.
Uh-huh.
Yeah. I know Canada's up there, but I don't know the numbers, you know, relative to the size of the Canadian economy. I know they're giving money away. I know my parents are getting free money that they didn't expect just by sitting at home.
So are you saying if all the countries are headed in the same direction, it's not a problem?
It's not, yeah, the US is the reserve currency of the world. We buy, you know, the world buys oil in dollars and we trade with China in dollars. As long as we have the dollar, we can do whatever the heck we want in the US. It's not the same in every country. Most countries, you know, have a risk of creating an inflationary spiral, right?
So are the Democrats suggesting any alternative direction, or is it pretty well determined by?
I think it's, you know, if Trump wins, right, it's going to be print a bunch of money for building bridges and roads and getting construction workers jobs and, you know, infrastructure spending, right? And then if Biden wins, it's going to be print a bunch of money for green projects and to give everybody, you know, $15 an hour minimum wage to sit at home, you know. so one might be bigger than the other, but I think they're both going to be in the situation of printing as much money as is needed to, you know, keep their constituents happy.
So Mark, if the pandemic could magically end tomorrow, would you see basically a K recovery?
Yeah, I think if the pandemic ended tomorrow, that would be great. It would cause the, you know, airlines and travel to come back. It would, some parts of the economy would be on fire, and I'll go through a few of those of my next slides here.
But you wouldn't see a V. We've gotten into enough hole that the idea we once had there could be a V, that's kind of evaporated.
Yeah, I think there's well, I shouldn't say that.
Okay.
I tend to be bearish. I tend to be negative on things. So I want to just start there with with that editorial. But you know, the U.S. economy is still in the best place around the world, right? We can do things that most countries can't do. So I think that there's still a really good chance that we could have a V if the pandemic ended. The problem is it would have to be like ending to the point where everyone was comfortable traveling again and going back on cruises, you know. And so there's always going to be certain parts of the economy that probably will never come back.
I don't know about never, but just a lot slower.
Yeah, in a 4, 5, 6 year period, maybe.
Or maybe 16.
Maybe. So just a couple of trends on interest rates. 10-year bonds are at 0.6%, right, over 10 years. So give your money to the government. In 10 years, they're going to give you 0.6% per year of a yield. The Fed funds rate is really at zero. It's 0.10. But long-term bondholders are pushing the rates down as well. So it's not just what the Federal Reserve is doing on the front end of the curve, but also on the back end. And mortgage rates are at 2.9%, so historic lows. And I was lucky enough to get a refi at 2.89.
You know, Mark, it almost seems like the only way that this recession/depression ends is through the end of the pandemic. Because I mean, how many tools are left if they've got interest rates at near zero and they're going on a tear in terms of stimulus spending,
Yeah.
but we've hit a wall where half the industries are soaring, the other half are crushed, and they'll never get off their feet without the end of the pandemic, and we can't do much more about the ones that are going up. So it's like, I think we've hit the wall as far as options, or
You
pretty
can't
close
go-
to it, without the pandemic ending.
Yeah, you can't go below zero, right? I mean,
Right.
if we go below zero, the banks go under. So, but what we could do, right? We could we could spend as much deficit money as we need to, because there's no inflation. As long as there's no inflation, we can spend money we don't have. It's some clock somewhere ticks up, right? But it doesn't actually tick
Yeah.
up, you know.
At some point, there has to be inflation if the rates keep dropping, right? The people are going to expect more in return for the money that has been devalued.
Right.
Right. Well, so this is actually kind of segue into the next couple of slides here. So this slide is showing a 20-year bond, and it went up 20% this year in value of holding a bond, and that's because the interest rates went down a couple percent. So people are making up for the lack of coupon by holding the asset. So they're feeling richer because they're holding bonds that have gone up in value a lot. And so basically what it's doing is it's turning everyone into an equity investor. So instead of a bond holder with expecting a 4% or 7%, you're having to push your
Shares.
money into shares and into
Yeah.
risky assets. This is a chart on housing. And these are housing companies, so the home builders. They're up 23% this year from the beginning of the year, and they're 138% up from the bottom. And this is just because, I mean, outside of the whole pandemic, they're at the perfect point where the millennials are starting to buy houses, and the next 4 years, the biggest group of millennials, you know, the biggest cohort or largest population of millennials is getting to be 28, 29 years old. And they're at that age where they're going to start buying homes. And there's not enough supply. There's not enough houses that have been built, especially the lower end starter homes. And so it's causing housing to go on a tear, really. And low mortgage rates means, you know, people can afford to spend $100 grand more than they did a few years ago. The lack of yield for bonds is another reason why tech is up big and why the overall stock market's up. So here you can see this is more than a V, right? This is tech companies are, you know, they're up 27% since the beginning of the year and 64% from the bottom. This is like an unprecedented run. And these are, you know, probably the top 20 large IT companies, tech companies, but they're really dominated by 5 or 6 companies: the Microsofts, Google, Netflix, those types of companies. Google, did I mention Google, Facebook, and these guys are money printing machines. Amazon, they just print money, right? They make a really good cash flow. They're in tons of debt, but they can make money in a situation where there's no return on investment anywhere else. This is a great place to park your money. Now, this is kind of the closest chart that shows like the regular economy, the regular S&P 500. I just want to pause here and say, we have had a correction the last 2 weeks. It looks like it got bought the last couple of days, Friday and today. So it's actually possible here that we're going to see all-time highs again in the next 2 weeks. I'm actually more bearish. I'm betting kind of against that, but that's where things are at right now. We're kind of on the cusp here of either another leg down or the rally continuing. Gold, you know, if bonds pay 0, gold pays the same amount as bonds. So gold has done really well this year, up 22%, almost as much as the tech companies. And this is the gold ETF here. You can see it's corrected about 15% from the top, but I think it's a time to buy the dip here. Gold does great in deflation because interest rates drop to 0. It does great in inflation because it's a hedge against losing the buying power of your dollar. So it's one of those assets that can rally in two different scenarios. It doesn't do well in between. So if we're going back and forth between inflation and deflation, it probably won't do well. But I definitely I like to invest in gold, a portion of my portfolio. Silver follows gold. It just moves faster. It moves harder in both directions. A little bit more. If you see inflation, you'll see silver come up because it goes into building things and manufacturing things. Bitcoin is kind of like a digital version of gold. So it's been up 50% this year. Very similar pattern to gold, but again, bigger swings. I will say it's a very speculative thing, and I wouldn't really. I recommend a small allocation, and I recommend holding it and not trading it, because trading is pretty tough. When you jump in and out, you might not make as much as if you just held it. But it is kind of a hedge against the collapse of the system. If the US dollar were ever to lose its reserve status, Bitcoin would go crazy. We're up to about 10,700 here on this chart. Copper and metals are doing great. That looks like a V to me, even better than a V. So electric vehicles and a lot of the heavy manufacturing, heavy projects use copper and metals, right? So this is the trend. It's all over the world. Copper is being used into building things. It also is used into building construction as well. Oil is the one commodity that's really sucking wind. It's down 35% since the beginning of the year. It also went negative for a day. But it's down to right around $40. And I think it's a great place to buy. I think oil will probably be up to 80 in the next couple of years. But for it to go lower than 40 is pretty rare. It's only during those shock events, when the stock market's dropping 10% a day because everyone's selling everything.
No, California says electric vehicles by 2035.
Yeah, good luck with that. They can't even keep the lights on over there, So they're probably going to use oil to burn just to make.
You got to plug in your car to light your house.
Right.
You're gonna need to learn how to stop forest fires first.
Yeah, right.
What's the best way to participate in oil? On the stock market?
Yeah, this is the chart for the oil companies. So I would buy oil companies the best way. This chart is the futures chart, but there's an ETF called USO that is a mix of multiple futures. So it has 6 of the future months in its basket, and it continually rolls. So as the first month futures expire, it buys the 6th month out. So USO is pretty good. It would follow this chart pretty close. And then the actual energy companies like ExxonMobil, pretty much any large energy company is going to have this chart. It has a chart exactly like this. It had a major dip, which was like a lifetime buying opportunity. And now it looks like it's coming down. The bottom part of the K again is coming down. And this is because these companies are having, a lot of them are funding projects, exploration, things like that. And all of the funding for those projects is drying up. So as the shale producers go out of business, these oil companies are going to be the cash cows because oil will go up in value.
Would Biden affect that?
Would buying
Biden.
Biden.
Yeah.
Yeah.
Yeah, actually the green, if there's green laws that come up, it could hurt these companies. I mean, a lot of the reason they're down, and they're actually at multi-year down charts. Like if you look at this chart over a multi-year period, we're way down. Exxon used to be the biggest company in the S&P 500, right? Now it's less than 2% of the S&P 500 in market cap. So they're down already because people think, well, the electric vehicles will take over. There'll be less demand for oil in the future. But that's just not even true. The amount of plastic we use every year it will offset the losses, you know, from electric vehicles. So I think that's great. The companies that are in place that are making good dividends already, that are making good profits already, are the ones to buy. And then you got to watch some of them in the basket. Might be those exploration companies that have a poor, you know, they're over leveraged, too much debt, and they can't make their payments. So some of those will go bust, and other ones will survive. So I'm actually I bought into Phillips 66, which is a refiner, because people still use gas and diesel. So, but it has a chart very similar to this, where I'm looking over a couple of year period, I should be able to make a really good return on that. And it really, the canary in the coal mine is banks. Banks are not looking healthy. They don't look like the other charts, right, of the tech companies and copper and housing. This looks really bad. It's almost like an L-shaped. And this is the chart of regional banks. The chart of the big national banks is very similar, just a little bit higher up. And you know, I'm watching this to see how it turns out. If we get another crash in the stock market, it's going to be led by the banks. You know, that'll take us down another leg. I don't know if we will or not, but I'm definitely not buying right now. I'm kind of watching.
Well, the big Canadian banks are paying dividends 5 and 6%, and they've got the funding to do it.
Yeah, the Canadian banks are probably better banks than pretty much every U.S. bank. So it might be that's a place to be if you want to play in the banks. I do worry about the Canadian housing market being overheated still, but I don't know enough to say, you know, if that's you know, I would watch for. I'd have to study that to look at it. I haven't been looking at the Canadian market for, you know, how much inventory and building is going on.
It would be a lot worse if they could get building materials.
Yeah.
You can't get lumber.
Yeah, lumber is crazy off the charts right now. So another sector
Is that true in Canada? I
Yeah.
thought our shortage was because we can't get lumber across the border from Canada.
No, it's you put it through your sawmill, it's sold.
Yeah, I heard that some of it was due to just like sawmills shutting down during the pandemic and it kind of the pent up demand of starting back up.
Yeah, that's true, but I don't know.
There's also, like, just in general, the U.S. housing market is on a tear, so that could be a reason for it as well. So airlines are not recovering yet, obviously. This is 3 charts, travel related. Hotel REITs look the same as cruise lines, and they look the same as amusement parks. You know, they're down 60 to 75% on all these charts here. And you know, will the cruise lines even survive is a good question mark.
Yeah, the interesting thing about the cruise lines is they were sort of in the crapper
Before
pandemic. I mean, with overbooking and legionnaires and disease and all this stuff. You know,
they're leveraged up really big to build all these mega ships, right? And you know, they borrowed. You know, they're very highly leveraged companies, and you know, will they be able to make their payments basically? And they can't really go get a bailout like the airlines can. You know, it's a different animal. It's really a shame. I love cruises, and it's a shame if they go out of business. It would be tough. All right, so I'll kind of wrap it up. You know, just what to watch as we go forward. I am pretty bearish right now, but I will like openly admit that I've been wrong most of this last 6 months. So, but I am looking at COVID trends, right? Hospitalizations, especially, and deaths. Of course, the unemployment claims on a weekly basis. If that pops up, that could be a tell. If the election doesn't get called on November 3rd, but there's too much debate about, you know, what's coming in the mail the next few days, and if we go to court arguing things, this could cause the markets to not be very comfortable. Will we get stimulus before the election? Right now, I think there's new talks this week, but you know, if you don't get stimulus out there, renters are going to have trouble paying their rents, and then landlords are starting to miss their payments to the banks, their mortgages. So
And just as a point, so my oldest son is a pilot for American Airlines, and he's being furloughed October 1. But they keep saying that there are ongoing talks, and if it's a deal, it's going to be last minute, of some kind of money. But the thing about the airlines is that when you furlough a bunch of pilots, it's not like, oh, the pandemic's over, get all the pilots back. They've got to spend 2 weeks in the sim because they haven't flown in 90 days.
Yep.
So they have, how are you going to get, 9,500 pilots recertified? It could take it could take 2 years to recover. So it's going to be interesting to see this sort of last minute thing. I talked to a couple of people who sort of speculated that this last thing about Trump's taxes are going to make him say, I've got to do something to distract from this. So let's do another big money giveaway. I don't know, but it's important to remember that that's not just on-off switch with regard to the airlines.
Yeah, and anyone I have 4 rentals in town with five units rented, and if so far everyone's been able to keep up with their payments, but I know these guys and the type of financial situations they're in. If you got 3 months behind schedule on your rent, you can get, right now you can't get evicted, so you're good till the end of the year. But then in January, you owe your landlord all the back rent all at once. Like, where's that going to come from? Nobody's going to be able to make up, $4,000 or $5,000 worth of back rent if they are behind.
Oh no, Mark, they're in Robinhood. They're doing fine.
Oh, well, those guys maybe. I gotta smoke what they're smoking. I've had a couple of successes on Robinhood, but most of the time I'm betting against those guys. And anyway, there's this like a real risk. I mean, we see Black Lives Matter and all the things that are going on, but I think their social unrest is not. It's related to a combination of things. This inequality in the country, and the haves and the have-nots, and just being locked down. I think all of that came together at the right time to kind of spark the social unrest. I mean, I'm in Minneapolis and I'm reading on Nextdoor, the app, reading every day about, carjackings in my neighborhood, like literally people coming up to your garage as you're parking the car and stealing your car at, a threat of a gun or something. And, stuff like that's going on. And, it's very difficult to stop the cycle here. And I think if the wrong guy gets elected, you're going to have people out in the streets fighting it. There's going to be, one group versus another, and it could really, snowball into something much bigger than we've seen so far this year.
Well, I would say that for 50% of the population, both candidates are the wrong candidate, right? I mean, it's which one's the wrong candidate depends on who you ask. Yeah,
well, and if it's not decided on November 3rd, like by a landslide, we have a problem. Anyway, watch for CPI inflation to see if that starts picking up. We're still kind of in this deflation cycle, but at some point inflation will rear its head, and that will kind of freak out the financial markets. Talked a bit about the tech stocks already. They're on a momentum trade right now. They're doing great, and they're the place to be. But it's will they buy the current dip, or are we at the beginning of a correction and a rotation into other stocks? And I'm looking at value stocks like oil companies and industrial companies, banks and miners. At some point we're gonna have a rotation into that trade, and when we see that rotation, that's really signaling that we're moving more into an inflation and growth market. And in the meantime, what's working today in the stock market is going to keep working in the meantime. Anyway, this was just my amateur hour here of what am I seeing. I do a lot of reading and listening to on macroeconomic podcasts and speakers and writers, and this is kind of my hobby. So,
hey Mark, so I'm sure you've read a lot about the potential of another 2000 bubble. What do you think the potential is that we're 2006 in the housing market and 1999 of the stock market?
So the housing market is not in a bubble by far, and the reason I say that, it might be that we're paying too much for houses, but it's not really the bubble scenario that we had in 2006 or 7. What we're seeing is there's no inventory, and there has not been any for years and years and years. And so that's causing values to go up, and people are chasing it. My son bought a house this year. It's been the same market for at least 8 years here, where you see a house you like, you have to pay what they're asking, and you might have to pay higher. There just is not enough inventory in the single family homes. For condos and apartments, yeah, there's probably a correction coming because they did overbuild, I think, on the apartment side of things.
What about in commercial real estate? Because there seems to be such a sort of diaspora of workers leaving New York and Philadelphia. And
I think, I would not want to be a commercial building owner in New York City or San Francisco or LA downtown. But overall, I don't know, it might come back. I mean, I think it hasn't changed forever. I think you're going to have tech companies with workers all over the country, but
what about Portland and Seattle?
I don't know enough about those
Well,
parts.
they have the high-tech workers, but they've got the social unrest problems, even worse than Minnesota.
Yeah. Well, I know, just an anecdote, a friend of mine moved to Lower Town, St. Paul, which is kind of an up-and-coming, loft area, old buildings but turning into a bunch of breweries and restaurants, ballpark, all in the same area. And they bought into this place that had brand new apartments. They were spending a couple $1,000 a month for their rent. And when the pandemic started, the thugs, I guess, or the drug dealers in Minnesota decided to pick their neighborhood as their staging ground. So they basically have created a completely horrible neighborhood now. It's all drug dealers and their customers. And even if the cops come by, they all text each other, so they all disappear and they hide in the alley as the cop drives by, and then they all come back out. These guys have caused all kinds of damage. Basically, what the biggest finding of this is, the entire building, a high-rise building, is 50% empty now because everybody moved out, and they had to pay $4,000 to $5,000 to the landlord to get out, just to break their lease. And so, if you're the landlord owning a building like that, you're not going to make your mortgage payments. You're giving that building to the bank, and that's just one example. It's just one area, but if the social unrest gets bad, that spreads.
That's happening all over downtown Minneapolis. Yeah, it's I know story after story where people are leaving. Some are leaving the country because they can.
Yeah.
Because a spouse has a passport, right?
Yeah.
It's happening all over Minneapolis.
Yeah, I live about a mile from where George Floyd was murdered, and on Chicago Avenue, and but it's a bit worse here, but it's not like we're running away yet. But you hear about people talking online like, hey, I should move out of town or move to the suburbs.
Hey, Mark, how much of the banking problem is tied to, obviously, the unrest, if it's causing problem for developers, but again, back to the pandemic, right, where it's just depressed commercial properties. Housing seems to be elevated, but the commercial market is in the toilet. And obviously they're hoping and praying for a recovery when the pandemic subsides. But I feel like this whole problem with banking in this country is that a huge dependency on real estate, and particularly in the commercial side.
Yeah.
And again, it just keeps coming back to this pandemic. They got to figure a way out of it.
I don't see a way out, right? Like the cycle of defaults is just starting. You know, as soon as landlords are legally allowed to evict people, it's going to get ugly.
So where does the liquidity come from? It all comes from the feds then? Because I mean, if the feds have been shoring up banks and banks are still not attractive because they're just hoarding the money rather than lending it because they're trying to stay afloat.
The bank can't lend money if they feel the lender won't be able to make the payments.
Right.
The banks are not comfortable lending in certain projects, depending on what it is. And, you know, and I don't know if they're lending. I mean, I'm having trouble getting my mortgage refinanced.
I mean, can you imagine a building and loan? Where do they go?
I'm hearing the exact same thing. The banks are tightening their requirements a lot. So I know a number of people are trying to finance their house or buy a new one or refinance their student loan.
Even we've seen that. Like our own company has seen that, and I personally seen that where all of a sudden they're tightening all these rules. So.
What kind of terms are they offering?
Like, go away.
On house mortgage.
No terms, go away.
Yeah, actually, you know what, John? I actually called a bank when Islay Group was looking for some funding, just sort of exploring like line of credit, and we're talking to one of the majors and then another major, and one of them said, it's one of the biggest ones in the country, is they basically stopped all commercial lending. I'm like, how's it possible? They're like, well, you know, it's just, it's the pandemic. We're going to revisit that. So, you know, maybe in the next few weeks. And anyway, I've been watching their stock price and it's absolutely hitting the floor. And there's a number of really big banks that are talking like, yeah, they don't want to do car loans. They don't want to do, even people that I know they're in the car business that sell cars. Most of the deals that they're doing are cash deals where people are coming in and paying cash for cars. Because banks are so nervous about lending.
You know, there's a shortage of cars on the lots here because the price differential between the States and Canada. The dealers make more money shipping their cars to the States than they do selling them here, because cars are selling in Canada in Canadian dollars for very little more than they are in US dollars in the States. A Toyota Camry starts in the States at 24.4 US, starts in Canada at 25.6 Canadian.
So you're saying, John, we should just get into the import business for Canadian vehicles because of the currency difference?
There's a lot of people in it.
Yeah, it's not the first time.
Yeah.
But how will that last if the Canadian dollar goes up? Or will it?
I don't see the Canadian dollar going up the way they're spending.
Look at the oil chart. The Canadian dollar follows the oil chart.
That's true. It's kind of a petrol currency.
Yeah. It'll come back, but
yeah,
at some point the U.S. will be deficit spending too much, and the oil price will go up, and therefore Canadian dollar will recover quite a bit.
Do you not think the social unrest may help Trump?
It does in a weird way, yeah, but it.
I mean, on the short term, like for the election.
Yeah.
How do you mean in a weird way, Mark?
Well, what I mean is, like, if there's social unrest, you know, well, just psychologically, I'll go through what we went through. You know, we were very sympathetic to the Black Lives Matter movement, and just, you know, it looked horrible how the police were acting, right? So we kind of went from one end of the spectrum of supporting the protesters to, you know, when they start, you know, burning down the buildings that we like to go have dinner at, you know, now we're like kind of flipping. so not that that I haven't decided who I'm voting for yet, but, you know, I could see it happening. I could see people kind of wanting to go back to normal and to how things used to be before the unrest. So, all right, so if you guys want to see my bonus chart, I have a chart for Bitcoin, and I always give this presentation. 2 years ago, I made a prediction that, you know, Bitcoin had just done a crazy spike to almost 20,000. And 2 years ago, I predicted it would follow this purple chart here, eventually getting to 100,000 in about 5 years. And just to give an update on the chart, we're not quite there, but we're kind of following along where I had predicted. 10,000 right now, and on our way. So I think, you know, it's, I play with it. I own some Bitcoin mining companies, and I own some Bitcoin and Ethereum. And really, it's a hedge against the whole system collapsing. So if we end up with a hyperinflation scenario in the US, which is very unlikely, or if we end up with a something big to change the reserve currency status of the US, then, you know, Bitcoin will be part of that new solution. It may never be a government-sponsored activity, but it will be kind of like your Swiss bank account was a few years ago. It'll be an alternative place to park the money. And so that's how I look at it.